Okay, well, first of all, thank you very much for the invitation to participate in this conference. This is joint work with Steve Utkus, that used to be at Vanguard, now is at visiting fellow and visiting scholar at Penn at Georgetown. Now, the motivation for this work, and by the way, yes, so the title of this work is Who Benefits from Robo-advising, Evidence from Machine Learning. The motivation for this work is that we know that most investors are not financially savvy. We know that when they are left out on their own, they make a ton of investment mistakes. They have all sort of behavioral biases when it comes to investing their wealth. And we know that financial advisors potentially could help, like human financial advisors. What are the main problems with financial advisors? One is they are rather expensive. So they usually charge between 1.5% or 2% per year in fees of assets under management. And also they tend to have, they tend to kind of cater only to relatively wealthy investors, because if the investable assets of the clients are not large enough, of course, there is not too much for the advisor to be gained in advising the client. And second, there is also kind of an emerging literature now showing that financial advisors tend to be rather ineffective, right? They are themselves subject to behavioral biases. They do not kind of tailor the portfolio of the customers to the characteristics, but in fact, you tend to have that financial advisor seems to allocate in the same way the portfolio of all their clients. Now, in principle, in a context or in a world that is populated by financial advisors, we could think that robo-advising could potentially be super helpful, because in principle, it can be super cheap and easy to use. And at the same time, it can reach millions of people at low costs almost instantaneously. And this space has evolved tremendously over the past decade, right? So here I have some companies, and this is even itself is a picture that is rather dated. So some of the companies that are listed here that are doing robo-advising, robo-retirement portfolio management, digital brokerage, did not exist 10 years ago, and many of them are actually already went bust. And so most of the research agenda that I'm working on now is exactly to understand how robo-advisors can help individuals making better decisions, right? So we have a number of papers with micro-authors that are studying robo-advising for investment decisions. Here we started with papers that were relatively descriptive at the beginning, and then and this is the paper I'm presenting today is a rather descriptive one. Now we're moving towards kind of trying to understand how, for example, individuals, what are the needs that individuals have, and trying to estimate for the behavior individuals have on the robo-advice platform, what is the degree of algorithmic aversion, and how can we reduce the algorithmic aversion of individuals using hybrid forms of robo-advice. But now there is also, I think that part of the research agenda that my co-authors and I have is trying to understand how robo-advising can help individuals making better decisions when it comes to other financial decisions that are equally important as investment decisions, right? So this may be how much to save, how much to consume, what kind of debt to take, and how to do, for example, lending or peer-to-peer lending. And so here, if you're interested, on my website, you'll see there is a lot of work that we are trying to do, is exactly trying to see how much we can automate all these recommendations for individuals in the context of consumption, saving, debt, and lending. Now, but this paper is going to be, once again, about trying to understand what are the effects of robo-advising on individuals. So we paired up with Vanguard. We work with their PAS, Personal Advisory Services. This is the largest hybrid robo-advisor in the world. At the time of the data set, which was like 2018, the robo-advisor had $160 billion in assets under management. And this was really larger than any other kind of all the other robo-advisors combined. And it had a kind of a very fast growth since the inception. Now, in a nutshell, what I'm going to show you is the effect that robo-advising has on individuals' portfolio allocation, and then who are going to benefiting more or less from adopting this tool. Now, in terms of the key features of PAS, if in case you have never worked with it, this is a hybrid robo-advisor, the way it works is that if you were signing up investors, you'd be profiled on your risk tolerance, investment horizons, demographic characteristics. Then you would have that, what we call the onboarding would stop. The algorithm would kind of propose a comprehensive financial plan that have a recommended portfolio strategy, the probability of financing a secure retirement, and also kind of some cash flow forecast that tells the customers what would be the cash flow that the customer would have at retirement. And then the onboarding stops. Before approval, the clients have to interact with a human that explains to them the plan. Now, the moment the robo-advisors is accepted, the moment that the customers decide to enroll for robo-advice, then all the trades are done automatically. The tool rebalanced quickly. And so really there was no control on the investment portfolio from the part of the investors. And so like this is kind of a very nice and unique setting if you think about it, because post-enrollment, all the portfolio allocations are mechanical. So it's difficult to argue that some of the changes we'll see in the portfolio allocation while robo-advice are not really the effect of the robo-advisor. And if anything, what we should be concerned by is the timing of sign up. And so we're going to have an identification strategy for kind of taking care of that concern. But also a second thing that I think is interesting, while we didn't have access to the actual algorithm, so I cannot show you exactly what would be the portfolio allocation given the characteristics, we can back it out using some very standard machine learning methods. And this allow us to understand what kind of, what are the benefits of robo-advice depending on individuals' characteristics. And just to give you a sense of the main findings before we get into the analysis, well, I'll show you that in general, across all clients, whenever you have an adoption of robo-advice, what we see is that pretty dramatic increase in bond holdings and decrease in cash holdings. We don't see that much of a change in the equity share. In terms of investment vehicle, we see a big increase in mutual funds holding at the expense of individual stocks and ETFs. And then finally, we also see that in terms of types of mutual funds, all the wealth is invested into index mutual funds and associated with that, there is a reduction in fees. Then we see kind of a big change in international diversification and also in terms of risk-adjusted performance. Now, when we move on to the heterogeneity, we find that all those customers with little experience, those that were doing a lot of trading before, that are benefiting a lot. And on the other hand, those people that were already kind of mutual fund passive investors, they benefit rather little from the adoption of this tool. But let me just get into the details. So we have 350,000 investors that interacted with PAS at some point. We have all their trades, we have all their positions, we have their age, gender, tenure. We see we can match to their trades and positions all the characteristics of the mutual funds, and we can match the returns. We can see also we can match all the stock characteristics and return. So effectively, you can think that for every investor, we have investor characteristics, investment performance, pretty much on every single day. And we also have information about like the attention of these individuals, and I'm going to show you some information about that towards the end of the presentation. Now, in terms of demographic characteristics, let me just show you that these are kind of investors that are surprising for some. Everybody always think that kind of robo-advisors are for kind of young individuals, for young investors. And this is definitely true maybe in the world of Betterment and Wealthfront. But if you think about the largest robo-advisor in terms of asset under management, which is Vanguard, is populated, like the average age of the customers is around 63 years. Half of them are male, and many of them had a very strong relationship with the asset managers. So they had already maybe 14 years. They were already over 14 years with a company before signing up with PAS. In terms of wealth allocation, these are relatively wealthy individuals. The average wealth is $600,000. The median is 280. These people have already kind of relatively well invested portfolio, in the sense that they are in most of the time in mutual funds and just maybe a couple of ETFs. So the total number of assets are approximately 8. They have the typical, on average, 55% equity, 25% bond, and 20% share in cash. And for the most part, they have that the most of the wealth is in mutual funds. There is a kind of a lot of cash holdings, and by the cash, I mean also kind of the money market mutual funds. And then we also have kind of that instead the individual stocks holding in ETF are not that large. Maybe they are like around 3% of the holdings and investors. In terms of indexation, 50% of the wealth is in index funds, very little international diversification. Either exposure to international funds or emerging funds is very small. Now, let me kind of show you a little bit of what happens to the portfolio allocation, just to show you that the dramatic kind of effects that we see is that if I take, for example, the average bond share and I deploy it in blue and I have in red the 95% confidence intervals for the mean, and I have that these are the month before signing up for Robo-advice, and this is the time of sign up, you see that the kind of the proportion of wealth in bonds basically shoots from 25% all the way to 40%. If I show you the dispersion, you can see that there is a lot of compression in terms of the dispersion in the kind of the holdings. You have that before some people had 0% in their in bonds, some people had as much as 60%. After enrolling, you have that the 10th and 90th percentile kind of are kind of getting compressed in the sense that you tend to have that portfolio allocations tend to be more homogeneous across customers. When it comes to indexation, you also see a very strong effect. You jump from 50% to 80%. And then also international diversification has this kind of big bump. You go from 10% of the invested portfolio to 30% of the invested portfolio being invested in international assets. And finally, you'll have that when I show you also how much the portfolios get homogenized, you can see that the effect is pretty large there over two. Management fees as a kind of functional indexation is reduced by quite a bit. You go from 12 basis points to 8 basis points on average. Now, if I show you what happened to the equity share, you will not see that much in a sense that the equity share will stick around 60%. But of course, this is rather misleading, right? Because you tend to have that, of course, some people are going to go in with very low equity shares. Some people are going to go in with high equity shares. So this is just going to be averaging the effects across the two groups. And this is exactly what you see. If I condition to those that have low equity share before sign up and those that have high equity share before sign up, you can see that they both go towards 50% in the first case and 70% in the second case, but they tend to kind of get closer to each other. And of course, we could spend our day trying to kind of look at this plot and see exactly what is happening. But one thing we would like to do is to say, okay, if we take two kind of measures that are important for us, like what is the portfolio allocations that people have and what is the investment performance, we don't really know exactly what are going to be the type of customers that are going to be benefiting. So why don't we have, and we don't know if the relationship between the various characteristics and the regressants are going to be linear or monotonic. So instead of having kind of a kitchen sink linear regression, let me just use a more flexible ML method like booster regression trees and let the data speak and see exactly how does the composition of the portfolio changes depending on the characteristics of the investors. So let me just give you a very brief introduction to BRTs, even though I think that most of you are very familiar with them. We know that machine learning is likely to outperform kind of traditional statistics if you have a large set of explanatory variables, if we have the potentially nonlinear, if you have potentially a nonlinear relation between the regressor and the regressors, and you have potentially many interactions between the various regressors. And so as kind of bigger data sets are becoming available also in finance and economics, these kind of machine learning methods are gaining momentum. Now, in terms of the typical kind of tools that people work with, like moving away from linear regression, you start having region, lasso, bagging, random forest, booster regression trees, and then you get into neural networks and deep learning and so on. For this paper, we just focus on something that is very simple, like booster regression trees, mainly because of their good out-of-sample performance, and then the fact that they are rather interpretable. Now, what is a regression tree? Well, you can write it, the fit of a regression tree, you can just write it in the form of a sum, where you have that if you take the space spanned by the various predictor variables and you kind of assign a constant to each variable, to each region spanned by these predictors, this is what kind of the fit of a regression tree will look like. Of course, when I show this formula, in many cases, I see that people don't really fully kind of grasp the concept. So I have a very simple kind of intuitive plot. What we're trying to do here is we're using partitioning, using lines parallel to the coordinate axis. What we're trying to do is to create a fitting function for the dependent variable by kind of splitting, taking the space span by the x1 and x2 variables and kind of splitting into various regions. How we're going to do it? With recursive binary partitioning. Now we know that recursive binary partitioning is going to be such that the kind of splits are going to end up being very hierarchical. And of course, you also have that as you tend to go through the splitting of the tree, you're going to be using less and less data. So you run the risk of overfitting the training data set. So what we're going to be doing on top of that is using a boosting algorithm. Boosted tree is nothing else but a sum of regression trees, where you have that the beef boosting iteration is just fit on the current residuals. Now we're going to use the standard implementation here in terms of how we implement it. So we're going to have a shrinkage and subsampling and so on and so forth. But just to give you a sense of what we are going to be able to do is that if this is the true data generating process in black, and imagine that I would have all the scatter plot of observations around it as the observation. Of course, if I was fitting a linear model, I would never be able to fit this kind of data generated process appropriately. If I use booster regression trees and I have one iteration, I'm going to have that the space span by the x variable is split in two regions. If I do 5 boosting iterations, I'm going to get these 5 regions. And then if you start having 10,000 boosting iterations, you're going to have a much better approximation. Now, we know that any semi-parametric or non-parametric method will work in low dimensional space, but the appeal of these tools like booster regression trees is that they are generally interpreted as kind of adaptive nearest neighbor estimators because they work well also in high dimensional spaces. Now, in terms of the implementation, we're going to be using small trees. We're going to have standard shrinkage parameters, and we're going to be using also subsampling. And these are kind of like standard off-the-shelf tools. Now, also, and finally, given that I'm going to spend a little bit of time on this, it's an advantage of BRTs compared to some of the other ML techniques is that they come with relatively simple tools for understanding and kind of being able to kind of comment on the results. So we're going to have the relative influence estimates. They're going to be telling us the relative importance of each predictor variable in the model. And we're going to have also partial dependence plots that are going to be able to tell us kind of what is the functional form relating each regressant and the regressor. Now, in terms of kind of implementation, so I'm going to start with trying to kind of convince you that this is an interesting tool, for example, to understand how portfolio changes at the individual investors level. So we're going to be working with the pre and post PAS equity share, just as one of the variables that we probably think is very important. We're going to be using 10,000 boosting iterations. And then as covariates, we're going to put everything we can observe. So we're going to have the age of the investors, whether they're married or not, whether they are male or not, the tenure at the company, and then all the portfolio locations and trading characteristics that we can measure. So we can see, for example, how much they were trading, their trading volume, the number of assets they hold, the management fees, as well as in terms of the portfolio locations, what is the percentage of the wealth in cash, in mutual funds, in stocks, in ETFs, in emerging funds, and in index funds. And in terms of the first kind of results, what you see is that the kind of a lot of the what really happens in terms of the relative influence that the equity share that investors have coming in really have explained pretty much everything of what is the change in portfolio location, right? So for those people that come in and have zero percent of the wealth in equity, on average, we see an increase of 30% of the wealth in equities. For those that have 100% of wealth in equities, they have a reduction in their wealth in equity by 30%. And then instead of those that come in with a kind of a 50-50 allocation, they kind of have the portfolio allocations kind of untouched in terms of equity share. Also, you have a kind of a strong effect related to age. So for those people that tend to be the younger people that sign up have an increase in their portfolio allocation in equities by 15%, and those instead that are on the older side, they instead have a decrease in their portfolio holdings. And this is kind of doing nothing else but undoing one of the biases that people have, that we know that individual investors tend to be underexposed to equities when they are young and overexposed when they're old. And so this tool is simply undoing this. And finally, you tend to have that the higher the percentage of cash that individuals have, the higher increase in the equity share that investors have. Now, you may argue that you would be able to see pretty much the same kind of the same results if we were using just a standard linear regression. And well, by the way, this would be the bivariate plot in terms of equity share and age and the change in equity share. But you would argue that potentially you could do similarly working with linear regression, and the answer is not really true, right? So here we find that the important kind of regressors are male, equity, percentage in equity, and cash. Linear model will tell you that also whether someone is a male or someone is married, and the number of assets and the management fees actually play a role. They have a kind of a statistical significant coefficient, and the intuition here is that potentially what is happening is that here you have that some of this nonlinearity in age, if you use a linear regression, would be kind of captured by the dummies on the married and the male. And so like you kind of have that doing this nonlinearity, using BRTs and the nonlinearity really helps in this dimension. Now, this was just the kind of what happens to the equity share that individuals carry, but we can also work with the performance, right? So if I have a very simple panel regression where I compute the realized monthly Sharpe ratio, I have individual investors, fixed effects, time effects, and then I have also this kind of dynamic specification where I have a dummy for individuals before and after signing up for Robo-advise. What you'll see is that before signing up for Robo-advise, the kind of the performance is pretty much the same as the long-term performance that individuals tend to have. Over the month of transition, you have a huge amount of trades that kind of affects the estimation of this returns and the Sharpe ratio. But right after, what you'll see is that if anything, that the performance just increased. So this is just to say that in terms of risk-adjusted performance, you tend to have that the individuals improve after working with Robo-advise. And of course, these are all results net of the fees charged by the Robo-advisor. Now, one of the problems of the results that I reported so far is that they do not, of course, control for the endogenous decision to sign up. And so people that sign up may be exactly the ones that before signing up were doing poorly, right? So we may be kind of overestimating the effect simply because you may see that someone has a kind of a dip in performance, and then they sign up for Robo-advise, and then they kind of revert back to the mean. Now we can have a solution. We have a kind of in the paper, we can construct counterfactual returns for those who sign up for those periods where they were not signed up yet. And then we can kind of do it because what the Robo-advisor is really doing, bucketing investors into categories. So we can construct almost a perfect counterfactual of how a person would have performed even before signing up. And we can confirm the results, our baseline results in this setting. But then the second thing that we think is interesting is to say, okay, if I take the changes, the within individual changes in abnormal Sharpe ratio, right? So if I compare how someone does before and after signing up for Robo-advise, and I compute the change in the Sharpe ratio, well, you'll notice two things. I'm going to have that some people are going to have very large benefits. Some people are going to have very negative outcomes, and this is something that we expect. Of course, what we care about is where this distribution is centered. The fact that it's to the right of the mean shows you that on average people improve. But now what we can do is we can use this same BRT tools I was using before to see exactly which kind of individuals tend to be on the right-hand side here and which kind of tend to be on the left-hand side of this distribution. So we're going to model the pre and post PAS abnormal Sharpe ratio using PRT. We're going to use exactly the same kind of specification, 10,000 boosting iterations, same type of shrinkage, and so on and so forth. And we're going to be using the same covariates I mentioned before. And here we get some kind of relatively interesting results. We find that if you kind of, some of the most important kind of predictors are like the tenure that individuals have. So the longer they have stayed with a Vanguard before signing up, the less they benefit from this robo-advice, maybe because after years they already were capable of doing rather well the investment decisions. Those people that have a lot of cash, they are the ones that benefit the most, hopefully, probably because exactly they just get kind of put into mutual funds and bond funds. You have that the number of assets has a kind of a nice non-monotonic shape. You tend to have those people that have very few assets and those that had a lot of assets benefit little, and the ones that were in between instead benefit a lot. And this is probably due to the fact that those people that were over here maybe already were just investing a couple of index mutual funds. The ones that were over here were just investing in individual stocks, and the ones that are instead over here are people that potentially already investing in individual stocks, but they have enough of them that they are well diversified. And then finally, you have that there is a positive relation between the traded volume and how much you benefit. Like just to say that those people that were kind of trading a lot, they really benefit from delegating their portfolio allocation to this automated algorithm. Now, if instead on the other side, you have those people that have kind of a lot of index funds already, they're not going to be benefiting that much, mainly because the tool put them into index funds. Now, this is kind of what we kind of have in terms of the performance changes and the portfolio allocation. But of course, when you sign up for Robo-advice, you can think of other benefits that you may have that go beyond the ones associated with portfolio allocation. In one case, you would expect, hopefully, that individuals would not need to pay attention anymore to their portfolio allocation as much as they used to do it before. And we can have a rough proxy for this. We have the total days with logins. What you'll notice is that if you look at how much people log in before signing up for the tool, and you have a kind of a big spike where at the beginning, where during the first couple of months, you have in the first month, you even have like a 5 additional kind of logins compared to the usual month, but then they revert back very quickly to the mean all the way to 12 months. And this is, and then you tend to have that the investors' performance, allocation, attention allocation kind of decreases. So after like 2 or 3 years of using the tools, they kind of decrease the logins per month by two on average. Now, this is kind of, if I consider the logins either with a mobile phone or with a desktop computer, if I add them all up, but if I split them, what you'll see is something that is slightly different, right? So you'll see that the attention through the desktop computer kind of goes down, but you tend instead to have that the attention through the mobile app increasing and stays constant. And so this is, once again, if I measure the attention using days with logins. And but what will come? But if I instead of showing you the day with logins, I show you the minutes per month, you'll see that in both cases, whether I use a desktop computer attention or attention through the mobile app, you see that they will decrease over time. So kind of what we kind of get from this is that what it seems to be the case is that it is the case that people kind of maybe pay attention more often through the mobile app just to check what their portfolio location is at. But in terms of overall attention and time spent on the platform and making decisions about how to invest the portfolio allocation, it decreases over time. Now, one kind of crucial aspect that I've not talked too much about, but I think it's kind of very interesting, and I think it actually comes into play into some of the follow-up work that I have with other co-authors, is the degree of human interaction. Now, if you sign up for a robo-advisor of a hybrid form like the one that Vanguard had with PAS, what you'll have is not only the ability to access the platform, but you also have interaction with a human. And so this is kind of the number of interactions that monthly interactions or dummies, whether you have an interaction given in a given month. So you see that, of course, at the time of sign up, you have a lot of conversations between advisors. And then what you'll see is that there is this kind of nice cyclicality where you have this kind of 3 months and 6 months check-ins. But an interesting thing about this is that depending on your level of wealth, you're going to have different kind of types of human advisors. So if you are below 500,000 in assets under management, you're going to be called what we call a level 1 investor. In this case, you're not going to have access to a dedicated advisor, but you're going to have access to a pool of advisors that are not going to be directly reaching out to you. And so you see that for this, you're going to have a very kind of a large kind of a type of interactions at the time of sign up, but then very few interactions. You may have clients here and there that call in, but you will not see a lot of interaction within a human. Now, if I show you the kind of instead of level 2, which is the people between 500 and 1,000 and 1 million in assets under management, you're going to see that they have a dedicated advisor that caters to them more. So you're going to see a lot more kind of this cyclicality and this kind of 6 months reviews and then a kind of meetings. And finally, if you are in level 3, which is assets under management above 1 million, you're going to have more interactions with more senior dedicated advisors. Now, what we try to do in a part of the paper that I will not have too much time to dedicate is trying to understand how much what are the sources of attrition. So if I compare, for example, males and females, you don't really see that big of a change in attrition. These are just simple Kaplan-Meier kind of estimates of the percentage of clients remaining with advice. So after 4 years of enrollment, you tend to have that approximately 82 or 83% of the customers stay with the service. In terms of tenure makes a difference. So those customers that had a stronger kind of or longer affiliation with the robo-advisor tend to have a smaller attrition. So these are the red ones in long tenure compared to the shorter tenure. It doesn't really make a big difference whether you are someone that is quick to enroll or not quick to enroll. But on the other hand, what you see here, and this is kind of very related to this kind of interactions, is that you tend to have that depending on the level of service you have. So those people that have a dedicated advisor, they have a much lower attrition. So you have after 4 years, only 10% of them drop out. The one that have kind of a dedicated advisor of a lower level, they have you have the approximately 18% of them drop out. And instead of those that are basically we're only kind of digitally advised in the sense that they don't have a dedicated available in a pool of advisor, you tend to have that 25% of them stay with the service, drop out of the service after 4 years. And this is kind of interesting for us in the sense that what we are doing now in follow-up work is exactly trying to use the discontinuity around the threshold to understand what is the degree of algorithmic aversion that people have and how kind of the human interaction can help. And what we're trying to explore right now in the next iteration is going to be what kind of meetings, conversation, and topics of conversation are related to kind of greater customer satisfaction and kind of lower attrition from the robo-advice. We have a lot of additional results in the paper where we kind of analyze what are the determinants of robo-advice sign up and then the determinants of robo-advice attrition. And then we put a lot of emphasis once again on the role of hybrid forms of robo-advice in exactly trying to affect both types of decision. Now let me kind of wrap up here and then get to questions if there is any. What we study is a robo-advisor that is kind of catering to investors that are already diversified, right? So we have some work showing with a robo-advisor from India, where that in previous work where we're showing that in many cases some of the kind of the robo-advised clients were benefiting only if they had rather poor portfolio location before signing up. This instead is an example of a robo-advisor that benefits investors that have already well-diversified portfolios. The robo-advisor, of course, has the potential to disrupt the entire financial advisory industry, and simple forms of robo-advisor can be very successful. We also show that the hybrid robo-advising can reduce attrition, likely because it reduces algorithmic aversion. And then we find that there are some significant benefits that are not necessarily related to financial performance, but they are related to the time saving of the individual face kind of when adopt the robo tool. Thank you so much, and looking forward if there is any questions.